the market's still digesting, as investors are still digesting the update we got from the policy change at the Fed following Fed Chair Jerome Powell's speech at the virtual Jackson Hole conference, discussing the move towards flexible average inflation targeting. And that, of course, is prompting conversations not just with Jerome Powell, but also other Fed presidents. And our own Brian Cheung got the chance to speak with Cleveland Fed President Loretta Mester just a moment ago for more on that policy change. And Brian, I want to bring you in for more on what you learned.
Well, Zach, I had the chance to speak with Loretta Mester. She's the president of the Cleveland Fed about the change that Chairman Powell unveiled yesterday. As you mentioned, the Federal Reserve saying it could tolerate inflation rising moderately above its 2% target at times. Now, that might be foreign language for a lot of people watching this show. But here's President Mester in her own words about what that change yesterday meant.
What's the best way to go about hitting our target? And that's where, letting inflation move up beyond 2%, and not only letting it, but actually saying that we are going to allow that to happen and actually take action for that to happen after periods where inflation has been low for a long time. That's the change in the strategy, is that we really want inflation to go higher than 2%, moderately higher for some period after it's been running too low.
And the emphasis from the Federal Reserve is that it's not using a specific mathematical equation to figure this out, but they are looking for periods of time when inflation has been running low before they then say we want to shoot for inflation that's rising above its 2% goal, which is kind of the situation we find ourselves in now, with inflation having run persistently below the Fed's 2% target since 2012. But a lot to chew on as we head into that next FOMC meeting, Zach, which will only be in a few weeks.
Well, let's chew on that some more here, Brian, with our next guest. I want you to stick around as we bring him in. Adam Posen is Peterson Institute for International Economics president, and he joins us now. And Adam, you just heard that discussion there as Brian was laying it out. I mean, it does seem like it's purposely vague here in terms of how far beyond 2% would be acceptable in letting inflation run hot. But what's your take on what it might mean for the market and what investors should be digesting here, as it does, to me, seem like it allows for a bit more room in trying to get unemployment back under control?
Yeah, I think that's exactly right. That this is an intent, as President Mester said to Brian, as Chair Powell said yesterday, that they are making a much bigger commitment to seeing how far they can drive unemployment down and to not worrying about the risk of inflation in a preemptive way, waiting until they see the whites of their eyes, to use an old expression. But I think in terms of the short term, there isn't very much impact for investors because it's not the Fed's fault or lack of action from the Fed that has inflation running so low right now. It's because we've got a huge number of people out of work and people are scared and people are holding off on certain kinds of spending and businesses are holding off on investment. And it's not clear that the Fed can affect that. Putting it differently, we saw long-term rates on the U.S. Treasuries, 10-year, 30-year, go up a little bit overnight following Powell's speech, but no major move either in those interest rates or in the dollar. And so that indicates markets don't feel there's any real news here.
So, Adam, it's Brian Cheung. If there's no real news here, I'm wondering if there is a downside maybe to what Chairman Powell unveiled yesterday. One challenge is the communication of all this that was discussed in the paper that was part of the program this morning, that getting inflation expectations is a really difficult thing because households and firms don't necessarily have the same expectations for what's going to happen in the future. Is there a risk that the Fed could get itself into a more jumbled communications mistake maybe in the future because of this change in their framework?
I think it's a fair point, Brian, and that paper you mentioned by Gorodchenko and others that was presented today at the Fed Jackson Hole is a pretty mind-blowing paper because it essentially says that they have a lot of good survey data showing that people think about inflation as the exact opposite way from the way central bankers do. So if that's true, then we got a whole different set of communications challenges. But I'm a little less worried about your concern, Brian, that they are getting themselves into a mess. Not because it's not going to be messy, but because the alternative was they're in the situation where they've been below their inflation target for years, where they made a mistake, as they're essentially admitting, raising rates a couple times between 2015 and 2018 when unemployment could go much lower. And so, they were communicating pretty precisely, but about failing, basically, not in a huge way, but failing. And now they're moving to committing to trying to do better. but it's going to be vaguer communication. I'm not sure on balance that's worse. I think it might be better.
So, Adam, it seems like this may have set the stage for what could be the next step for monetary policy, which would be a little bit more relevant to the here and now, which would be something like forward guidance, where the Fed would say we won't raise rates until the unemployment and or the inflation rate hits a certain target. But I saw your tweet thread yesterday. I know that you've noted that forward guidance can at times be largely useless. I'm wondering if you could expand on that. And within the context of what we see now, what could you see the Fed doing in future meetings if they do take on forward guidance?
Well, I think you're absolutely right, Brian, that there is an incentive in the here and now to apply this new strategy, and that would seem to mean either a new communication or a new tool. It's not clear what the new tool could be, so it's probably communication. So, yeah, and dovish friends of mine have raised ideas of commitments and rules where you say what you just said, that instead of doing time-dependent forward guidance, you say, we're not going to raise rates until X occurs, until unemployment is below something or until inflation is above something. I tend, and this goes back years, have been a skeptic about forward guidance for two big reasons. First is you can't bind the committee in a credible way what's going to happen 2 years from now. I mean, not only is it possible that the membership of the committee or even the chairmanship of the committee changes, but it's the circumstances are going to change. There is no legally binding way. It's not like Congress passes a law. The committee says something now, they can change their mind. And so people, I think, appropriately don't necessarily believe these self-imposed statements. The second thing is there are so many forces right now pushing down on inflation and pushing up on unemployment. And this is the kind of thing that was also talked about at the Fed Jackson Hole conference, the paper about why interest rates are so low, the paper about why the trend growth rate has fallen, both of which I think were very mainstream and sound papers. And Powell cited those as facts motivating the strategic change. And so if you're in that environment, and especially if you're sort of aware of things and you're aware that inflation's been running low for years despite the Fed saying otherwise, and if you're even more aware and you look around in Europe and Japan, their central banks have failed to get inflation up either, you know, why is just saying something going to work?